o'clock. I think we can get started here. Good morning, everyone. My name is Tyson Moore. I'm an accounting supervisor in the not-for-profit division here at DWD. I want to thank everyone for joining today's webinar. With us today, Susan Berghoff and Phil McKenzie. They're directors here at DWD, along with our presenter and partner, Carrie Minnick. Before we get started, I have a couple housekeeping items to cover. For those of you who have questions during today's webinar, please use the Zoom's question and answer feature. You should see that option at the toolbar at the bottom of your screen. We will be answering questions periodically throughout the presentation like normal. Also, Carrie's slides will be emailed to everyone attending the webinar today, along with being posted to our website after the presentation is finished. All right, that's everything I need to cover. I'll now turn the floor over to Carrie to start the webinar.
Thanks, Tyson, and welcome everyone. Today, we are going to talk about what does it mean to be tax exempt. So before we get started, let's just take a minute to look at the word tax exempt versus nonprofit. Federal tax law provides tax benefits to nonprofit organizations recognized as tax exempt underneath the Internal Revenue Code. So what we're talking about today is actual organizations that have received their tax exempt status from the IRS. The nonprofit terminology is a state law concept. So nonprofit status may make an organization eligible for certain benefits at the state level. So just want to understand that there is a difference between nonprofit and tax exempt. I will refer to nonprofits today, and we will using that terminology as tax exempt. So just because an organization is not a nonprofit doesn't mean that it's necessarily tax exempt under the IRS. So we just want to make sure that when we are working with a nonprofit that we understand what its actual status is with the IRS. We're going to talk about some activities today that could jeopardize your tax exempt status. Some taxes that nonprofits pay and don't pay, annual filings that have to be done, and then some other key topics to be aware of as a nonprofit organization. So first, let's talk about jeopardizing your exempt status. So you've worked really hard to get your exempt status. You filed the application with the IRS, there was a fee to be paid, and now we want to make sure that we don't lose that exempt status. And one of the things that could possibly cause us to lose the exempt status is mission drift. So as a tax exempt organization, you received that status from the IRS because of your activities. So for example, a 501c3, you maybe had an educational charitable mission, you may be a church or religious organization. There are several different kinds of nonprofits, organizations that can receive tax exempt status from the IRS. The idea here is that when you applied to receive that tax exempt status, you told the IRS that you were going to be doing specific programmings, you have a mission, and the IRS approved that mission and that program. So if, down the road, several years later, your mission has changed or your programming has changed, we need to make sure that we report that back to the IRS, because if there is too much mission drift and you drift too far away from what that original purpose was that the IRS approved, they might not like that. And then any revenues that come in from these new changes, activities, programming, they may consider that unrelated business income. And we're going to talk about unrelated business income a little bit later, but too much unrelated business income within a nonprofit is not good, and the IRS does not like that. So we want to make sure that we are reviewing our mission consistently, on an annual basis or every so many years to make sure that we are still following that original mission. And if we do need to change it a bit, that is okay. That's okay to change your mission as long as you're not, or programming, as long as you're not drifting too far from the original mission. If you do decide to change some of your programming, you need to report that to the IRS on your annual Form 990. There is a question on there as to whether any changes in programming have occurred since your last 990. So you just need to report that to the IRS. And then if they approve your 990, then they're basically approving those changes. So we just want to make sure that we are communicating any changes to the IRS. Something else that could jeopardize your exempt status is private benefit and inurement. So The point of a nonprofit organization is to serve the public interest, not a private one. So no part of an organization's net earnings may inure to the benefit of an insider. So basically, we don't want to an officer, a board member, your executive director, your CEO, they should not be receiving any kind of private benefit from the organization's fundings. Now, yes, your CEO, your executive director is going to get paid. They receive a salary. You just need to make sure that it's reasonable for their background, their experiences, what they're doing. Board members, they can be paid, they can be reimbursed for expenses. Some nonprofit boards also pay their board members for board service. That's fine. It just needs to be reasonable. We just don't want to have any kind of additional private benefit on these types of insiders. Then there's also the inurement. So no economic benefit to any person who is able to exercise substantial influence over the organization's affairs. And so those could also be directors, higher level management, could be a significant funder. So again, we want to make sure that the organization is operating for the benefit of the entire community, and that individual people are not getting any kind of specific kickback or benefit from the organization. Political campaign intervention. So this is a very timely topic. 501c3 organizations are prohibited from directly or indirectly participating in any political campaign activity. So what does this mean? If you are a 501c3 organization, you cannot make any kind of public statements for or against any person running for office. No political campaign contributions. This is at all levels, so federal, state, or local. However, you can provide certain voter education activities or activities to encourage people. They just need to be done in a nonpartisan manner. This political campaign intervention is not intended to restrict any kind of free speech. So if your organization leaders decide to make statements individually, which they certainly can, they have the right to do that. They just need to make sure that their comments and opinions are their own individual opinions and comments and not that of the nonprofit that they represent. One thing that comes up with political campaign intervention sometimes is a lot of nonprofits have fundraising events or special events, and you might have a political candidate or someone in public office be invited to appear or speak at your organization's events. That's fine. You just want to make sure that there is no indication of support by the nonprofit politically. So again, it's okay to have the mayor or someone, governor, come to your organization's special event fundraiser. That's fine. We just want to make sure that we're very careful as a nonprofit and that we don't try and support one candidate over another or one party over another. So just being careful. Now, there are two other types of activities kind of related to political activity. That is lobbying and advocacy. So unlike political activity, lobbying is considered activities that intend to influence legislation. It's basically drumming up a call to action. 501c3 organizations cannot engage in a substantial amount of lobbying. However, they can engage in some type of lobbying. And then also the other type of legislative activity is advocacy. And obviously advocacy is what all of the nonprofit organizations doing. It's really what a nonprofit does every day in trying to advance their mission. This really involves more educating people. The process of making your voices heard on issues that affect the lives and the lives of others. So everyone, no matter what type of nonprofit you are, you should be advocating for your mission and what you're doing. And again, that's more of just educating people on what's going on. Lobbying, 501c3 organizations can engage in some, but not substantial lobbying. The next slide here kind of gives a summary of the 3 different types of legislative activities. We have political activity, lobbying, and advocacy. And then across the top, we've listed some different types of nonprofit organizations. So again, this is not an all-inclusive list of all tax-exempt entities, but some of the more common ones. And you can see what is allowed and not allowed for each of these different categories. So just making sure that you, first of all, know what type of entity you are, and then also what you can and cannot do in regards to political activity, lobbying, and advocacy. So those are some types of things that may jeopardize your exempt status. That's not an all-inclusive list, but those are kind of some of the bigger things to keep in mind. Now we're going to talk about taxes. So as a tax-exempt entity, there are some taxes that organizations, nonprofits still have to pay and some that they do not. So the first type of taxes we're going to talk about are payroll taxes. So obviously a nonprofit, if you have employees, you are going to have to pay payroll taxes and then also withhold payroll taxes. So federal income tax withholding, FICA, just like a for-profit, you're going to have to pay those in. Now, federal unemployment taxes, FUTA, if you are a 501c3 organization, you do not have to pay FUTA. If you're another type of tax-exempt entity, then you would have to pay FUTA. But if you are 501c3, so charitable, educational, scientific type of entity, you should not be paying FUTA. State unemployment taxes for the state of Indiana, nonprofits have to pay. However, you may opt to become a reimbursable employer. A reimbursable employer means that the organization will reimburse the unemployment trust fund for benefit payments to the former employees instead of making regular quarterly contributions. So instead of making a quarterly payment for SUTA, you would just make a payment when a former employee goes to collect unemployment. You still have to file the quarterly payroll reports. It would just be 0. In order to become a reimbursable employer, there's a form that you have to complete with the Department of Workforce Development. Once this status is elected, the status cannot be changed for a minimum of 2 years and will remain in effect until the employer revokes the election. So it is an option if you would like. If you would like to be a reimbursable employer, though, you have to complete the form. If you have a small number of employees, or maybe you don't have a lot of employees, not a lot of turnover where they would go and collect unemployment, that might be an option for you to become a reimbursable employer versus continuing to pay into SUTA throughout the year. One thing also to note that in Indiana, the term employer for a nonprofit means that the organization employs 4 or more individuals in 20 different weeks during the same calendar year. So if you employ only 1 or 2 individuals throughout the year, you are not considered a nonprofit employer in the state of Indiana. Your employees would not be able to go and collect unemployment taxes. So just something to keep in mind related to payroll taxes. Next, property taxes. So this is really relating specifically to Allen County, Indiana. However, I'm sure a lot of the other counties have very similar rules and regulations. So in Allen County, nonprofit organizations can receive an exemption from paying property taxes. However, you have to file an application for property tax exemption. So you actually have to file a form and get it approved. Some nonprofits may not get 100% of the property tax approved to be exempt. Sometimes there's a partial exemption depending on what the property is used for. Even though you receive a tax-exempt status for property taxes, you still have to file an annual property tax return every May 15th. This is for personal property. If your property is moved, so let's say you move from location A to location B, you need to file a new exemption to make sure that the assessor's office is aware of that transfer of property. And also when you purchase a new building, new land, you need to file an application for exemption as well. Make sure that's done by April 1st of the year that property is purchased. So again, you don't have to pay property taxes if you have applied for and received property tax exemption. One thing to note, in Allen County, there is an exemption for personal property taxes under $80,000. This personal property tax exemption does not apply to nonprofits. This is only a for-profit exemption. The nonprofit property tax exemption overrules this personal property tax. So if you have less than $80,000 of personal property, don't assume that this $80,000 exemption applies to you. It does not as a nonprofit. This $80,000 exemption only applies to for-profits. So as a nonprofit, you have to file your tax exemption, your nonprofit tax exemption, to receive the proper exemption from paying property taxes. Okay, let's talk about sales tax. So this is a big one. So in Indiana, when a nonprofit may be exempt from paying sales tax. So this is first, let's talk about the purchases side. So when a nonprofit goes to purchase items. So in the past, you had to file a form with this Department of Revenue to receive a sales tax exemption number. In order to be exempt from sales tax, a couple things have to be in place. So you're not automatically exempt from sales tax. You have to file the application. The purchases of the items have to be made by the nonprofit organization. It cannot be made by the nonprofit's employee. So if you send an employee to Walmart to purchase it and the employee makes the payment and they use their own credit card or they pay for it with cash, and then they go back to the organization and ask for a reimbursement, technically that purchase should have sales tax paid on it because the purchase was made by an individual and not the nonprofit. I know sometimes stores will allow sales tax to be exempt on those types of purchases, but technically the purchase should be made directly by the nonprofit. So invoiced to the nonprofit and then paid or paid with the nonprofit's credit card. That's the first thing. And then also the items purchased must be used for the same purpose to which the organization is being exempted. So just because a nonprofit, a tax exempt entity, 501c3 goes and makes purchases doesn't mean that they will automatically be being exempt from paying sales tax on those purchases, depending on what it's going to be used for. So if you're buying program supplies, that's what your part of your mission. Sales tax is going to be exempt. If you are purchasing something for your board members, that's probably sales tax probably should be paid on that because that is not specifically related to your mission. So I know sometimes those things can be kind of gray, but technically these are what the rules are. Now, and then every year, in order to maintain your sales tax exemption, you have to file an NP20 with the Indiana Department of Revenue to maintain that status. All right, so effective July 1st, 2022, the state decided to make some changes to sales taxes for nonprofits. What this part here about what is the payments being made directly by the organization being used for the same purpose, that did not change. That is the same. What changed is that prior to July 1st, if an organization, and again, I'm sorry, this is related to the sales that are made by nonprofits. Let's go back. Sorry. Back to purchases. In order to maintain your sales tax exemption, you have to file an NP20 every year with this Department of Revenue. Effective July 1st, that changed. So now we have to file every 5 years an NP20R, which is called a nonprofit organizations report. That must be filed electronically through your organization's in-time account. So for 2021 tax year, filed in 2022, you need to file an NP20 like you always had. You can either do that on paper or you can do it electronically through your in-time account. So those NP20s that are due in 2022, do it the same way. Then going forward, the next time the form that you have to file, it's going to be the NP20R instead of the NP20. And it's also going to be due on a different date, depending on your EIN. So it's either going to be due May 15th in the year 2024, 2025, 2026, or 2027. And again, that depends on the last 2 digits of your EIN. If you could go to our website, you can see there is a recent blog that gives more detail as to what EINs are due in which year, so you can look that up. Once you file that first NP20R, then you will need to file another NP20R every 5 years from that due date. And again, that must be filed electronically through your organization's in-time account. If you do not file electronically through the in-time account every 5 years, you will lose your sales tax exemption. So you want to make sure that that change is being made. Now, if we go back to the sales side, so that was nonprofits purchasing items. Now let's talk about nonprofits that actually sell items. So before this change happened in 2022, sales were exempt from having sales tax collected if they were not carried on for more than 30 days in a calendar year. So it didn't matter the dollar amount of the sales, as long as the sales were made for 30 days or less, they were exempt from having sales tax paid in. However, effective July 1st, 2022, the 30-day rule has been repealed. So again, there's no change into what is being taxed. What has changed is instead of the 30-day rule now, we're looking at dollar amount. So if you have $20,000 or more sales, then you have to start collecting sales tax. If you have less than $20,000 in sales, you do not have to collect sales tax. Again, there is no change into what is being taxed. However, this does bring up a kind of something that maybe some organizations have not thought of before. A lot of nonprofits have fundraisers or special events where they will sell items in an auction. If that auction raises more than $20,000. Again, this is a sale of tangible personal property by a nonprofit. Then technically, according to this Indiana sales tax information, the organization would have to collect sales tax and remit sales tax on that. I did have a call last week with the Indiana Department of Revenue discussing this. They didn't have a good answer for me, so they were going to look into that. There is an exemption for auctions. Sales tax bulletin 13 or 17, I believe, specifically says for charity auctions, if a charity auction takes place and there is an outside auctioneer in that is actually auctioning off the items, then those sales are exempt. But I know a lot of nonprofits have fundraisers, special events where they have silent auctions, so there is no auctioneer. So according to these sales tax bulletins, they would not be exempt from collecting sales tax. And if you made more than $20,000 in sales at the event, you might have to collect sales tax. So again, I think this is a gray area. I don't think there is I'm waiting to hear back from the Indiana Department of Revenue to see what they say on this. So I will keep you all updated through our blogs and future webinars on what I hear back. But that is something to think about, because according to how the bulletins read currently, if you have an event and you auction off items through a silent auction and receive $20,000 or more in proceeds, you should have to pay sales tax. So again, keep in touch with us and we will keep you updated on that. Obviously, if you sell items that are specifically related to your purpose, like for example, books, like if a school sells books, it's directly related to their educational purpose, you do not have to collect sales tax on those items. Actually, it's sales tax bulletin number 20. That's the one that has the specific exemption for charity auctions. But again, the exemptions or the exemption is specifically to charity auctions conducted by an auction company. It doesn't say anything about silent auctions. So again, we are still looking into that. Might be something new that some organizations need to consider going forward. Okay, moving on to another type of taxes, unrelated business income tax. So nonprofits don't have to pay income taxes. However, you do have to pay taxes on unrelated business income activities. So what is an unrelated business income activity? Well, three things have to be in place. It has to be a trade or business, has to be regularly carried on, and not substantially related to the organization's exempt purpose. The IRS does not care what you do with the money. So if you have an activity that's really not related to the organization's exempt purpose, it's really carried on and it's a trade or business, but you give all the money back to the organization and it's going back to its mission, does not care, still counts as unrelated business income. Unrelated business income is based on the activity creating the income, not what is done with the income. So we need to remember that. It's also on a case-by-case basis. It's a very gray area. What is considered unrelated business income for one organization is not always unrelated business income for another organization. So for example, if nonprofit A has a coffee shop, and what their mission is nothing at all related to the coffee shop at all. They just have a coffee shop because they want to make some extra money and think that that's a good way to do so. So they hire employees to sell coffee. They bring in money, again, not related at all to what their mission is. That would be considered unrelated business income. Organization B has a coffee shop. Well, their mission is to help people that maybe have been imprisoned get back into working and develop working skills. And so in order to do that, they have this program where their program participants participate in the coffee shop. So they, serve the customers, make the sales, that type of thing. So in organization B, the sales that come in from the coffee shop probably would not be considered unrelated business income because it is related to their mission and what they're doing. So again, very gray area. You need to look at all of the facts and circumstances that are surrounding the activity. Some common examples of unrelated business income: advertising. The IRS straight out says any advertising, that is going to be unrelated business income. If you are selling merchandise that is not related to your mission, so for example, you are selling t-shirts that just have the name of your organization on it, nothing else related to what you're doing, that's probably going to be considered unrelated business income. If you receive rent income on debt finance property, so if you have a building and there is a mortgage on it and you lease part of that space out to somebody else, doesn't matter if it's a nonprofit or not, then the rent received on that is probably going to be considered unrelated business income. There are some specific instances that are excluded from unrelated business income. So for example, fundraisers that are conducted by all volunteer workers or where donated merchandise is sold is probably going to be exempt from unrelated business income. So as a nonprofit that has a tax-exempt status with the IRS, you can have some unrelated business income activities. That's perfectly fine. You will have to pay unrelated business income tax on these items. That's fine, especially if the income coming in is well worth that small amount of income tax that you have to pay. However, if you have too much unrelated business income, the IRS does not like that because again, the IRS gave you your tax exempt status because of the good things that you're going to do as a nonprofit, not because you are going to conduct an activity like a for-profit entity. So just something to keep in mind. If you have new revenue sources, especially during COVID, I know a lot of nonprofits tried to create new revenue streams, which is great. You just need to make sure that none of them are considered unrelated business income activities, or if they are, that you're properly reporting that and paying the taxes related to that. Next is excise taxes. So excise taxes are kind of considered a negative, maybe imposed for doing bad things. We talked earlier about, excess benefit transactions between the nonprofit and a disqualified person. So if there is some kind of excess benefit transaction, the IRS will tax the nonprofit and also the individual participating in it. And that's called an excise tax. If you have political expenditures for political activities, again, we talked about 501c3s not being allowed to and be involved in political activities. If you have political expenditures, or if you have excess lobbying expenditures, so you are involved in substantial lobbying expenditures, those are bad things. And so the IRS is going to make you pay excise taxes on these types of activities. Now, private foundations are a little bit different. So we have public charities and then private foundations. So private foundations, they actually pay excise tax on their net investment income. And in this it might be negative that they have to pay a tax, but that's kind of what they do. So they do have to pay excise taxes on their net investment income, which is reported on the 990 PF. They may also have to pay excise taxes on some other things, like some other bad things that they may do, self-dealing, if they fail to distribute income. So as a private foundation, you're required to annually distribute a certain amount of your net investment assets. Usually that's 5%. So if you fail to do that, then you might have to pay excise taxes, excess benefit, business holdings, jeopardizing investments, and taxable expenditures. So normally excise taxes are considered more punitive. However, private foundations do have to pay excise tax on net investment income. So there may be instances where a nonprofit would have to pay excise taxes. Likely private foundations would, on a reoccurring basis, have to pay excise taxes. Okay. So those are kind of some of the taxes. There may be some other taxes. Those are the main ones that we wanted to go over today. Let's talk about annual filing. So as a nonprofit, there are some things that you have to report back to the IRS. So again, you're not paying income tax, so you don't file an income tax return. However, the IRS wants to know what you're doing. They want to know where you're getting your money from and what you're doing with it. So you have to file an annual Form 990. Okay, there's actually four different forms of the Form 990 that your organization may be required. You're going to have to file one of these each year, and it depends on the type of organization. So if your organization is not a private foundation, but a public charity, and your gross receipts are normally less than $50,000, you can file the 990N. This is the simplest version. Basically, it asks your organization's name, address, a contact person's name, and then a checkbox that said, do you normally receive less than $50,000 of gross receipts? That's all it is. It is filed electronically online. So that's, if you have less than $50,000 in gross receipts, that's very easy to do. There are some organizations, like I said, private foundations cannot file 990Ns. Supporting organizations cannot file a 990N, but in general, if you have less than $50,000 in gross receipts, you can file a 990N. Now, the next level is a 990EZ. So if your gross receipts are less than $200,000, and again, when we're talking about gross receipts, we're talking about money coming in from all sources, contributions, investment income, program service fees, all types of gross receipts. Gross receipts less than $200,000 and total assets less than $500,000, you can file Form 990EZ. So there's a little bit more involved with this than the 990N. You do have to report your board members. There's some financial information, and then there's some additional questions that need to be answered. Next level up is the Form 990. So if you have $200,000 or more in gross receipts, or $500,000 or more in total assets, you have to file Form 990. So this is the big form. This is the one that has a core form of 12 pages, and I don't know how many different schedules that you might have to fill out as well. So that's the biggest form. And then private foundations, if you are a private foundation, you have to file Form 990PF. So if you're a private foundation, you can only file 990PF. If you are an organization that receives normally less than $50,000 in gross receipts and can file the 990N, if you want to file the 990EZ or the 990, you can. If your organization has less than $200,000 and you can file the 990EZ, but if you want to file a full 990, you can file a full 990 if you'd like. Sometimes organizations will file a full 990 even if they don't have to, and they could file a 990EZ to provide additional information. We're going to talk about different documents that are out there for the public to look at, and the Form 990 is one of those. And so if an organization submits their Form 990 to funders, it gives them more information about the organization, so they may choose to file a full 990 versus a smaller 990. It's just up to the organization. However, whichever form you file is due the 15th day of the 5th month after year end. So if you're a December year end, your 990 is due May 15th. If you're a June year end, your 990 is due November 15th. So June year ends, that's next week. If, for example, you are unable to file by the deadline, you can submit a 6-month extension. The extension has to be filed by the May 15th or the November 15th deadline. So again, December year ends, if you have filed an extension, your extended due date is November 15th. That's next week. So make sure that you have all of those returns done. You cannot file an extension for Form 990N. That's just so small that they don't think you need an extension on those. Each of the forms, no matter what form you file, must be filed electronically. Paper filed returns or incomplete returns are considered not filed by the IRS. And there are penalties for late filings. It's either $100 a day, or it's either $20 a day if you have less than $1 million in gross receipts, or $100 a day if you have more than $1 million in gross receipts. There is a maximum of $10,000 and $50,000 on those penalties, but just know that there is a penalty for not filing. And if you fail to file your return for 3 consecutive years in a row, you're going to lose your tax exempt status. And again, we really don't want that to happen, because if that happens, then you're no longer considered a tax exempt entity. People cannot get deductions when they give you contributions. You are going to have to be reinstated. So you're going to have to refile your tax exempt application and repay any fine or admission fee, application fee that goes along with that. Churches and religious organizations are not required to file Form 990. Just keep that in mind as well. We talked a little bit about unrelated business income. So in order to report this to the IRS, you have to file Form 990T. So if you do have unrelated business income of $1,000 or more, you do have to report that to the IRS on Form 990T. It is due the same time as your 990 is. There is an extension. If your tax calculated is more than $500, then you're going to have to pay estimated taxes as well. So that's how you report that to the IRS. Next, I just want to go over some additional aspects of being a tax exempt entity that you should know about. A big one is government funding. So there's different types of government funding. There's a direct federal grant where you get the money directly from a federal entity, whether it be, Health and Human Services Department or the Housing Urban Development. One of those government entities is giving your organization directly the money. There's also can be federal grants that are passed through a state or local government. So maybe, HUD gives money to a state entity, and then that state entity gives you the money. So there's a flow through there. There's a pass through. There's also can be a fee for service. You can get money from your state or local government. You could get money passed through another nonprofit to you that came from a government entity. There's also loans and non-cash assistance. So you need to know where your money is coming from to determine if it is any kind of federal money, whether that be from the federal government, the state government, or local government. In Indiana, if you get money from a government entity, you're required to fill out Form E1 each year. That's the entity annual report. And that reports your government funds received and dispersed during the year. So the Indiana State Board of Accounts, this is done online through the Indiana Gateway. So if you as a nonprofit receive government money, whether it be from the federal, state, or local entity, then you need to report that to the state. Then the state is going to determine whether an audit is necessary. Sometimes they say, okay, it's fine, you don't need to have an audit. You can submit your 990. Other times you do have to have an audit done. So the State Board of Accounts is responsible for the oversight of Indiana organizations that receive government funds. They're the ones that decide whether or not it needs to be done. There's a calculation that's done. So just make sure that if you do receive any government money and you're an Indiana nonprofit, that you're reporting that to the state. The other thing about government funding is if you spend $750,000 or more in federal money during the year, so this is not receiving it, this is actually spending it, then you're going to have a single audit done. So again, if you get $1 million in 1 year, but you only spend $500,000, you don't have to have a single audit done. A single audit is much more in-depth than a financial audit. So if you have had a financial audit done, that's great, that's part of it. But then there's the other piece of it is the compliance audit, where your auditor is going to come in and look to see how you spent the funds, if it was used for the proper expenses that the government said it was supposed to be used for, much more involved, which means it's going to cost you more and it's going to take you more time to get ready for it. Not all auditors can perform a single audit. So if you have an audit done by an auditor, and if you're planning on getting additional government money where you're going to spend more than $750,000, you might want to plan for the future and first of all, determine if you're going to need to have a single audit done, because again, it's going to take more time and it's going to cost more, but you're also going to need to find out if your auditor can do a single audit, because there's additional education that your auditor has to do and experience with single audits. Our nonprofit team at DWD can do single audits. So if you have questions, you can always contact us. Also, if you have a single audit done, you have to prepare and submit a data collection form that is due within 9 months after the end of the fiscal year, and that is done online. So the key thing here to remember about single audits is if you spend more than $750,000 in government funding, federal awards, you have to have a single audit done. And your data collection form has to be due within 9 months after the end of the year. So that means your audit needs to be completed before then. So if you haven't had a single audit done and that you think that might be something that you need to look at into the future, you might want to contact your auditor to find out what needs to be done in regards to that, so you can properly plan for that, because there's some additional specifics that need to be done that I won't go into here. Okay, this is a big one, public support test. So I'm sure since you are involved with the nonprofit, you have heard of the public support test. It can get kind of confusing. So we're going to try and explain it in layman's terms, basic understanding of what the public support test is. When a nonprofit when an organization receives its tax-exempt status from the IRS, it is considered either a private foundation or a public charity. So it depends on where you're getting your money from. So private foundations, they get their money, their support from one source or very few sources. So for example, Fullinger Foundation in Fort Wayne, that is a private foundation. They get all of their funds from the Fullinger family. Public charity, Big Brothers, Big Sisters, they get money from a whole bunch of different foundations, companies, individuals, lots of different entities supporting them. So they're a public charity. Each year, when you file your 990, there is a form, it's called Schedule A, that does a calculation to see if you are still considered a public charity. So if you are a public charity, you want to stay a public charity. If you fail this public support test, you will become a private foundation, which means you're going to have different rules to follow. You're going to have to pay excise taxes. You don't want to become a private foundation. Organizations that originally applied to become a private foundation, they want to stay a private foundation. They're fine. This doesn't affect them. It's the organizations that applied and are public charities that want to stay a public charity. So what this test does, it looks at the current year and then the prior 4 years. So for 2021 or 2022, we're going to look at 2022 and then the prior 4 years activity. So we're not just looking at 1 year, we're taking an average of 5 years. We look to see where all of your money comes from, and then we do a calculation. If that calculation comes out to 33 1/3%, then you're good. You've met the public support test for the current year and the next year. But if you don't meet that 33 1/3%, then you're not considered a public charity for the current. If that percentage is less than 33 1/3%, but you had 33 1/3% last year, then you're okay. You're still considered a public charity for the current year. But if you recalculate it next year and you're still under the 33 1/3%, then that means you're not a public charity anymore and you've automatically become a private foundation. So the key is to know where your support is coming from. So you're probably not going to be able to calculate this public support test. That's okay. You need to know that it exists and you need to know where your money is coming from. It is important to receive support from lots of different sources as opposed to just a few. And if you have large grants from private foundations, individuals, or corporations, they can easily upset the public support test. So again, we don't expect you to know how to calculate this, but we need you to know what it is. So when you're looking at your 990, so this is depending on the type of entity you are, there is one of two schedules that you will complete. You will not complete both of these. So you're either going to complete part 2 or part 3, depending on the type of nonprofit you are. But these highlighted lines here on lines 14 and lines 15, we want those percentages to be more than 33 1/3%. If they are less, that is bad. If it is declining, so you can see the line underneath of the line I've highlighted as the prior year. If you can see that number, that percentage is going down, so maybe it was at 60 and then it moved to 50, or maybe it was at 50 and then it moved to 40. You need to be aware of that and determine what is making that decrease. So there are some other specifics involved in the calculation. There are instances where we do take some donors out because of they're publicly supported. So I won't get into any of that detail, but you need to be, again, aware of the public support test and that your organization is meeting that. So you need to look at your 990 to see what your percentage is. So that way you can make sure that you remain a public charity, because we want to stay a public charity if we have already been a public charity. I have seen instances where the organizations are not aware of this percentage and they have actually lost their public charity status and become a private foundation. It is very difficult once you become a private foundation to become a public charity again. So please be aware of this. Just a few more things. Contribution substantiation. So that is when donors make contributions to you, whether it be cash or in-kind items. In order for them to get a deduction on their individual tax return, they have to have a written acknowledgement from the organization. That written acknowledgement needs to include specific items like the organization's name, the date of the contribution, the amount of the cash that was given. So that way that they can take that deduction on their individual tax return. The written acknowledgement must be contemporaneous, which means that it needs to be provided to the donor before they file their tax return. So a lot of times organizations will just either right after the contribution is made or soon after year end will provide these types of thank yous or statements on donations. It is the donor's responsibility for donations of $250 or more to get this. It's not really on the organization. However, most organizations do provide this just to make it easier on their donors. If somebody gives you non-cash items, so supplies, services, or whatever that's not cash, you would not give a value in this written acknowledgement. You would just give a description. So for example, somebody donated 10 pizzas for your program lunch for the kids. You would just say, hey, thank you for the 10 pizzas. You would not put a dollar value on that. It is the individual's responsibility to determine what that value is. Now, if an organization does sell, have quid pro quo exchange transactions. So this would be when a nonprofit has a fundraiser and they sell tickets and the ticket is $100 and part of that ticket is going to cover my meal cost of $25. And then the remaining $75 is a contribution. That's considered a quid pro quo transaction. Part of it's a contribution, part of it is an exchange transaction where I get something in return. Then the nonprofits are responsible for providing documentation back to the donor that purchased that ticket as to how much the $100 was for food versus the contribution. So it's just good practice to give thank yous to your donors, acknowledging what they gave to your organization. As a nonprofit, again, you receive benefits from the IRS, and so the IRS expects you to provide some disclosures to the public. Again, a nonprofit exists for the benefit of the community, for the public. Your Form 990 for the last 3 years is open to public inspection. So if anyone can come into your organization and ask you for a copy, you will find your Form 990 also on the websites. It is on the IRS website, it is on GuideStar, it is on Candid, so it is also out there. All schedules need to be included in that 990 except for your names and addresses of donors on Schedule B. So if you put a copy of your 990 on your website, which is perfectly fine, a lot of organizations do, go to it and make sure that Schedule B does not include your donors' names and addresses. We do not want that out there. That is not open for public inspection. If you fail to provide your Form 990 to the public and somebody comes and asks for it, there is a penalty for that. Your tax-exempt application. So way back when your organization first started, they filed either Form 1023 or 1024 with the IRS. If it was filed after July 15th, 1987, you have to make that available to the public if somebody asks for it. And then also your IRS determination letter. Although not required, the IRS encourages the disclosure of financial statements, annual reports, conflict of interest policy, and other governing documents. They think it's good practice for nonprofits to make those items available to the public. A lot of nonprofits do include those items on their website. However, again, it is not required. You do not have to make your financial statements and those items available. You only are required to make your Form 990, your tax-exempt application, and your IRS determination letter available if somebody asks for it. Again, you don't have to put all these 3 items on your website. It just needs to be available if somebody asks for it. As far as governance, obviously nonprofits are run by boards of directors. The IRS believes that a well-governed organization is more likely to be in compliance. So we just want to make sure that our board consists of active members, independent members. So not everybody is a family member with everyone else, or not everybody works at the same company. If you have everyone working from the same company, you're not going to get a diverse viewpoint. So making sure you have board members that represent, again, diverse backgrounds, education, experience, etc. You want to make sure you have regular board meetings. You want to make sure you maintain board minutes. In Indiana, the state requires a minimum of 3 board members. There is no maximum, so you can have as many as you'd like, but you do have to have 3. And then finally, the last thing I want to talk about is just policies. As a nonprofit organization, there are several policies that your organization should have in place. These are the ones on the screen here are just a list of some of the best practices, policies for nonprofits. If there's something on here that you see that you don't have currently in place and would like a copy of, we can certainly provide that to you. Just let us know. You will see some of these policies have an asterisk beside them. Conflict of interest policy. The IRS Form 990 asks if you have a conflict of interest policy in place, and actually the IRS will not approve a tax exemption application without a conflict of interest policy in place anymore. So make sure you have that in place. And then the other 2, the document retention and destruction policy and the whistleblower policy. Again, Form 990 asks if you have those in place, that they should be written. But those also were the 2 of the policies from the Sarbanes-Oxley issue way back when with Enron. Many of the items under Sarbanes-Oxley apply only to for-profit entities. However, these 2 apply to nonprofits as well. So making sure that you have a document retention and destruction policy and whistleblower policy in place. Again, some of these policies are asked for on the 990 if you have them in place. So it is good best practices to have those in place. All right, so I think that is all I have today. It looks like we've had some questions and I think they've mostly been answered. So I just want to thank you for attending today, and I think Tyson is going to wrap it up.
Yes, thanks, Carrie. Just as a reminder, the session was recorded, so the slides and video will be available on our DWD website in the not-for-profit section. A link to the section will also be emailed out to everyone attending today. While on our DWD website, please visit the not-for-profit webinar page where you can register for our next webinar that will take place on December 7th. We're going to talk about various checklist items that you need to prepare for your year end. So we're going to talk about things like budgeting, W-2 forms, 1099s, and a few other topics. As you can see on our slides here that we don't have any topics for 2023 set up yet. We are still going to hold our monthly webinars though. We're currently working on choosing what topics we're going to cover for 2023. So if you have any ideas or on specific topics that you want to know more about, feel free to email Carrie or anyone on our not-for-profit team. We'd love to hear your ideas. With that being said, I want to thank everyone for joining us this morning and have a great rest of your day.